Warren Buffett, renowned as one of the most successful investors in history with a staggering net worth exceeding $120 billion, has captivated the financial world with his exceptional long-term investment principles. In this video, you'll not only gain valuable insights into Buffett's 9 essential investing principles, but you'll also take your English skills to the next level. So, stay with us until the end and feel free to revisit as many times as you need. The knowledge gained will be priceless. And, as always, happy learning!
1. Focus on intrinsic value.
In general, value refers to the worth, importance, or usefulness of something. This concept involves considering the benefits and qualities of an item, service, or concept. In the context of investing, value is like discovering the true worth of an asset, such as stocks or bonds. It requires figuring out the real value of an investment by carefully examining crucial aspects of the company, like its earnings, financial health, and growth potential. On the other hand, intrinsic, in a general sense, refers to the real, actual, or true value of something. Let's take the example of buying a car. While the shiny paint and a popular brand might catch your eye, the real value lies in the engine, safety features, and overall performance. Similarly, in investing, Warren Buffett encourages us to understand a company's true worth, going beyond its current market price, and focusing on what a company is genuinely worth, beyond the flashy numbers. So, when Buffett says, "Focus on intrinsic value," he's guiding us to uncover the authentic value of a company, something that goes beyond what the market might be saying today.
2. Margin of safety.
Margin. The word margin in general refers to the difference or gap between two things, often indicating a certain amount of space, leeway, or extra room. It's like having a buffer or safety cushion. In financial terms, margin is the gap between the cost of something and its selling price. To illustrate, imagine you purchase a bike for $100 with the intention of selling it for $150. The $50 in between represents your profit margin. Margin of safety means buying an investment for less than it's really worth, creating a cushion or buffer to protect against unexpected changes in the market. It's like getting a discount and adds a layer of safety to your investments. Warren Buffett follows this principle by actively seeking investments where the market price is significantly below his calculated intrinsic value, ensuring a built-in margin of safety for potential market fluctuations.
3. Economic moats.
Economic, in a general sense, it is related to money, businesses, and how a country manages its resources, like land, labor, and goods. It's about the financial aspects of a system. Moats. In a literal sense, a moat is a deep, broad trench, often filled with water, that surrounds a castle or fortress. The purpose of a moat is to serve as a defensive barrier, making it more difficult for invaders to approach the castle walls. Economic moats. In the context of business and investing, it metaphorically describes a competitive advantage or barrier that protects a company from its competitors. It refers to unique qualities or advantages that make it challenging for other businesses to compete effectively. similar to how a moat protects a castle. When Buffett talks about economic moats, he suggests it's wise to invest in companies with strong, defendable positions in their industry. This way, they can avoid tough competition and have a better chance of making money for a long time.
4. Predictable earnings.
Predictable. Think of it like a routine, or something that happens the same way every time, just like your daily schedule. For example, if you always eat breakfast at 8 a.m., your breakfast time is predictable because it happens regularly. Earnings. In the business world, earnings refer to the profits a company makes. It's the money the company has left over after covering all its expenses. Predictable earnings. When we talk about a company having predictable earnings, it means the company consistently makes a similar amount of profit over time. Investors like companies with predictable earnings because it shows stability and reliability in their financial performance. It's like knowing your favorite TV show comes on at the same time every week. You can count on it happening regularly. Similarly, predictable earnings in a company suggest a reliable and steady financial performance. Warren Buffett follows the principle of predictable earnings by choosing to invest in companies that consistently make profits. He looks for businesses with a reliable history of earnings, as this indicates financial stability and a strong business model. Companies with consistent earnings are more likely to handle economic downturns and uncertainties successfully. This approach helps him select investments with a higher likelihood of long-term success.
5. Rational decision-making.
Rational refers to making decisions based on reason, logic, or sensible thinking, rather than emotions or impulses. Decision-making is the process of choosing between alternatives or options. It involves evaluating information, weighing pros and cons, and arriving at a conclusion. Rational decision-making is the practice of making choices based on sound logic, reason, and a thoughtful analysis of available information. In the context of investment decisions, Buffett exemplifies rational decision-making by relying on a thorough and logical evaluation of relevant information. This way, he avoids making decisions based on emotions or temporary market changes, making his investment strategy more logical and systematic.
6. Market fluctuations as opportunities.
Market fluctuations. These are changes or movements in the stock market, where the prices of investments go up and down. Opportunities. These are favorable situations that can lead to positive outcomes or benefits. Market fluctuations as opportunities. This means seeing the changes in the stock market not as negative events, but as chances to find good investments at lower prices. How Buffett uses this principle? Buffett views market fluctuations as opportunities to buy stocks of great companies at discounted prices. When the market experiences temporary declines, he sees it as a chance to invest in quality businesses at a better value, expecting them to grow over the long term.
7. Conservative financing.
Conservative. This term refers to being careful, cautious, and avoiding unnecessary risks. Financing. This involves providing funds, or money, for a business or project. Conservative financing. This means being cautious and careful when it comes to obtaining and managing funds for a business. It suggests avoiding excessive debt and choosing stable financial practices. Buffett prefers companies that use conservative financing, meaning they don't take on too much debt and manage their finances carefully. He looks for businesses with stable and reliable financial structures, as they are less likely to face financial difficulties and can withstand economic challenges more effectively.
8. Long-term perspective.
Long-term refers to a significant amount of time into the future, often years or decades. Perspective, the way someone looks at or thinks about something. Long-term perspective. This means looking at things with a focus on the distant future rather than immediate results. It involves considering the larger picture and being patient over an extended period. Buffett emphasizes having a long-term perspective in investing instead of being concerned with short-term market fluctuations. He looks at the enduring value of an investment over the years. This approach aligns with his philosophy of holding on to investments for the long haul, believing that long-term success often outweighs short-term gains.
9. Invest in businesses you understand.
Buffett's advice on invest in businesses you understand boils down to this: stick with what you know. Instead of diving into complicated industries or businesses, focus on the ones you're familiar with. Buffett encourages investors to make well-informed decisions by choosing companies where you grasp how they operate, their competitive strengths, and potential for success in the long run. The key here is to align your investments with what you understand best, increasing the chances of smart and sound choices. In simpler terms, it's like saying, invest in what you know inside out. This way you can better evaluate the risks and potentials of your investment over the long term. Buffett's approach is all about being cautious and knowledgeable when picking stocks, making it a thoughtful strategy for investors